Gold is a leader, and gold is more establishment. The banks keep buying it. The banks know what's happening, and I'm sure in their darker moments, they probably don't sleep well at night, thinking there could be a banking crisis, a banking failure, some type of money center bank that goes down, a failure to arbitrage between the yen trade and the interest rate swaps. Remember, this quadrillion or so in derivatives, almost all of that is interest rate bets, and not everyone can cover their bet. It's all equal. There's the same amount of long and shorts and all that nonsense. The point is that thing is so overextended that there will be failures, and there will be people that are not able to make good on their bet because they lost it and they don't have the cash to do it. So there's a lot out there, and it mostly revolves around, as I said earlier, the debt market or the U.S. Treasury market and bets on interest rates. And we've got a lot of problems out there in that sector because it's supposedly the safest part of the market you can be in. And the truth is, it's probably the least safe place you can be in.
Right.
Mr. Gold, what's your view on gold?
Well, gold is money. And central banks, why are central banks buying so much gold? Because they understand that gold is real money. Everything else is credit. Their paper's credit. US dollars are credit. What David just talked about with the derivatives, just to put that into just plain English, it's a zero-sum game. There's going to be winners, there's going to be losers. The problem is the losers, when they lose so big that it bankrupts them, then the winners become losers because they don't get paid. It takes everything down. So while you are waiting for the system to come down, where do you park your money? You park your money in money that cannot bankrupt. There's only two monies that can't bankrupt. That's gold and silver. I think you're going to see silver outperform gold simply because of the ratio. I don't know what number it's going to get down to. Does it get down to 40, 30, 20? I don't know. Nobody knows. Well, once there's a break in the derivatives market, you're going to have a permanent plateau. You're not going to see a 1980s event. You're not going to see a 2011, 2012 event. You're not going to see gold and silver go parabolic, and then all of a sudden start to evaporate again. And the reason being, where would you, in a system that breaks, where are you going to put quote profits from gold and silver? Where do you hold those that are safe?
Well, I do. I mean, you could do a thought experiment and say, look, gold comes off. Let's say it settles at, let's say it just stays static. It doesn't move. Let's say it's at 4,600, and there's a big financial crisis, and the stock market gets cut in half and the real estate market gets cut in half. Well, what's your gold done? Effectively, it's doubled because, again, we don't want to think too much in paper price. We want to think in value. What does an ounce of gold buy in the Dow Jones? What does an ounce of gold buy in oil? What does an ounce of gold buy in real estate? Well, for real estate market, a lot of people that buy gold also are real estate investors. There's a crossover. Point being is that gold could stay the same, but if real estate's cut in half, what's the gold worth? In real estate terms, it's doubled. And that's something people don't really think about often enough. But I think it bears repeating because that's something to really burn into your consciousness. You got to look at gold for what it is. As Bill keeps saying, it's the ultimate money. As the late, great Jim Dines used to say, gold is the monetary hitching post of the universe. Well, I think there's some nuances to this story. So let's break it down in the real basics. I mean, what is the real source of silver supply? 850 million ounces per year is mined. 150 million ounces is recycled. So you have 1 billion ounces. So where's the COMEX fit into this? And of course, when we're talking silver, I want to distinguish between the silver market, which I define as 1,000-ounce bars, and the retail silver market, which is it's very important, but that's not where the price is determined. The price is determined in the derivatives markets, 1,000-ounce bars to back it up, not silver eagles, not silver maples. So the COMEX is very small in physical terms. Historically, less than 1% of the futures contracts actually go out for delivery. Almost all are rolled forward, closed for cash, or even when delivery occurs, it's often warehouse warrant transfer. The metal doesn't move. The COMEX contribution to the real world physical supply is well under 5%. It's often misleading because much of the bank-to-bank reshuffling is not new supply. It's just moving the owners of that pile of silver back and forth, and it's happened for years. The LBMA, that's a little bit of a different story. It's the largest physical silver market in the world, and it's an over-the-counter market, and that's where clearing and settlement takes place. The banks hold about 27,000 tons, which is 870 million ounces, much as that's in the ETFs, as most silver investors know. It is the biggest marketplace for silver, but the nuance is it doesn't produce any silver, and it's a clearing, allocating, and redistribution center of existing metals. So the basic thing is 95% of the silver goes from the refineries into the fabricators, the industrial users, the people that use it for paste, solar panels, et cetera, and investors, because those 1,000-ounce bars do get broken down into coins, medallions, 1-ounce wafers, 10-ounce wafers, kilo bars to 100-ounce bars. So I think the main thing is that, as I think we all know, COMEX is for futures hedging. It's a paper game. It obviously controls the price and has for years. The LBMA does clear, but it's mostly vault transfers. Some does come out. We know that. And most of this metal on these deliveries is reallocated, not moved.
Yeah, David's absolutely correct. COMEX was never intended to be a delivery market. And he's right, 1% or thereabouts going the last 18 months. The deliveries have increased and continue to increase. Matter of fact, over the last 18 months, whatever stood for delivery on first notice day, by the end of the month, there would be more standing for delivery at the end of the month. That's been going on for the last, like I said, at least 18 months, up until March. This March, after a month where 40 million was delivered in January, 25 million in February, and we had 52 million standing at the beginning of the month, with a inventory of, I think it was 73 million at the time. By the end of the month, it was down to 40 million. That was the first month in 18 months where there was less standing for delivery at the end of the month than at the beginning of the month. We also saw something, and I think we've seen it 3 times now. The CME itself stood for delivery, not for a huge amount of contracts, but I've never seen CME stand for delivery. Now they've done it 3 times. So it's become different than what it was up until 18 months ago. My only thought is you have arbitrageurs who know that they can sell it silver for 70, but they're not positive that they're going to get delivered on. So are you going to take the chance where you're buying silver at 75, but you can't get it to deliver to your sale at 85? Do you really want to be making silver in Asia?
Yeah, and Dave,
Danny, I want to add to what we were just talking about. Understand that COMEX is a paper exchange, and what David was talking about, we're going to get sellers at 100. That very well may be the case, and I'm sure you will get some sellers because you got some people that jumped in at 100, 110. Expecting it to be a moonshot. It's pulled back and they'll liquidate and go, boy, I'm glad I'm out. What I'm going to say here, and I've said this about this rally phase that we've been in, this is the rally. If you're buying metal physically, you do not sell it. And if you're buying silver, if you're buying gold, it should only be physical. Because if you're buying paper metal and there's a default, you're not going to get paid anyway. So just stack your metal, sit on it. If you know what the end game is, who cares how we get there? As long as you arrive.
I have done swaps when the gold silver ratio gets out of whack. I traded palladium for silver probably at almost exactly perfect time when we were in April and gold had made big moves, and silver and platinum were just sitting doing nothing. In my paid report, I said, don't buy gold, wait, it's going to level out at 3,500 through the summer, which it did, and buy silver or platinum. And as soon as the ink dried on that report, platinum and silver both took off. So, and also just to back Bill up, I mean, look, I believe in the free market. And if you stack silver for, X amount of time and you want something or you got a goal, it's your money. I just finished the $100 silver party in Las Vegas for my members. It was a wonderful event. One guy came up with almost tears in his eyes. I'm exaggerating slightly, and showed me the boat he bought. His life dream was to own that boat, not to own a bunch of blocks of silver till he died. And I was happy for him. So in that case, the guy lived his dream, right? And silver helped him achieve it. So I'm not saying sell your silver. I'm just saying it's a case by case basis in my view. But to back Bill up, I mean, the one thing I said when I was telling my people, I wanted to take partial profits, go ahead. I think we're going to stall out in the 100 plus range, but don't sell it all no matter.